Welcome back, friends. As discussed yesterday, I am recording a video on value investing. This is going to be a little detailed one because this will talk the process, how to go about, what are the issues, and how to really filter and set a right price for buying a stock. Hope this will be very helpful. So please see the whole video and write back your comments in case you feel something about it, because your comments are going to make it better for future. So let's get going. So the topic, as I discussed yesterday, value investing, a time tested method for making big buck. So if you do really value investing, you can really make a big time gain if you follow the discipline and you have patience. Discipline and patience are must, because it's not a place where you can be in hurry. You have to be convinced about it. You need to have confidence and then get going and wait patiently, because you don't know whether it is going to give you the return in 6 months or maybe a year or so. So these two are very, very critical for this particular value investing. Now I am talking very quickly some basics. A stock is a portion, a small portion of the total equity of a company. You can call it stock, equity, or shares, whatever you are confident with. So basically, when you buy a stock, this means you are buying a ownership in the company. So let's say if you are buying a stock in TCS, what it means is you own TCS to that particular percentage. Let's say TCS has got 10,000 shares and you buy 1,000 shares, then you own 10% of TCS. So you may have a very minimal percentage, but you own the company. That is very, very important. This means what? If the company does well, you will do well in terms of financial performance. If the company does badly, you also suffer the loss. So therefore, when you buy your equity, you buy reward and risk associated with that equity. That is very, very critical, and we need to understand that. So basically, returns in equity comes from two sources: dividend and capital appreciation. Our well-performing company normally issues dividend every year. So whatever they pay, that will come to your account directly. And that is what is called dividend. But normally dividend is a very small percentage. It could be 1%, and for some stock it could be 2, 3, 4% also. But the biggest gain a person makes is from capital appreciation. So let's understand with help of an example what the capital appreciation is. So let us say you bought a stock and price of that stock as on 1st of April 2020 was rupees 200. And just after 1 year, if the price becomes 240, that is on 31st March 21, then the appreciation or capital appreciation is 40 rupees. This means if you sell the stock after 1 year, you make 40 rupees, which amounts to 20% gain. This is what we call capital appreciation. So good number of stock investment is meant for capital appreciation. Now it's very important to understand what is price and what is value. Very tricky thing. Now price is whatever is quoted is in the market is the price. This means today a stock is quoting, let's say 500 rupees, the price today is 500, and it might change tomorrow to 475 or 525, because the price keeps on changing every moment. Just to understand it in a very layman language, the price is what you pay and the value is what you get. This is a quote by Warren Buffett actually, which I'll talk a little later. And to give you another example, let us say a lot of us, particularly I also look for sales which comes once in a year, a big sale on Amazon as well as Flipkart. And there, even a branded product, a very good branded product, you get a significant discount. It may so happen that Allen Solly, a shirt which might be normally available at 2,500 rupees, you get at about 1,000 rupees. So that is what is the value. Another example which comes to my mind, sometimes value could be very huge. Let's take for example, consider a person who is likely to get married, he is dating, and he buys a diamond ring for his fiancée. For him, the value could be enormous. Even though he may pay X amount of money, but value could be very high. But by the way, in stock we don't do that. In the stock we compute the value. So there are methods for finding the intrinsic value of a share. And normally a prudent investor will always buy stock at a lower, if the value is lower than the price. So let me show you with help of an example. Like in this chart, the solid line is the intrinsic value. There are many methods of computing intrinsic values, but I am not going to deal with those methods, but that is what is going to take a full course on the subject, which I eventually plan to create a course for those of you who are interested in that. So you may have to wait for some time, but for the time being, I'll certainly give you some solution which will work without getting into that course to maybe extent of 50-60%. So let's say this is the intrinsic value. Let's assume that for the time being. And this is the stock price variation. Now stock price keeps on moving on a daily basis because price is determined by demand and supply. It is also a function of fear and greed. So it's a balancing of the two. So when the price is below the intrinsic value, at any point you can procure the share. Like maybe it is very hard to find out the lowest point, but maybe even though you buy here or you buy here, you are good. But when price crosses the intrinsic value, like let's say here, this is certainly not a good price. Maybe you would like to exit at this point in time. That is very, very important. So this is what is the intrinsic value, and if the price is lower than the value, then we buy it. If price is higher than the value, wait patiently. Warren Buffett waited for 13 odd years for procuring JP Morgan. He spotted the share, but the value he was looking at, the price he was looking at, which was lower than intrinsic value, came to his way after waiting for 13 years. So I'm not saying you have to wait for 13 years, but patience is the key here. So what we learned is price is not value. So you have to look for whichever it is. This is a famous quote by Warren Buffett. Price is what you pay, value is what you get. So that you need to keep in mind. Now situations to watch. Which conditions this might happen. So normally when there is a big fall in the price, let's say pandemic started. Now company's performance didn't change overnight, but price fell a lot. So these are the situations you need to watch at. Similarly, there could be a piece of news for a particular company and the price falls all of a sudden. So that's the point to watch. That time you might get it at a lower price which is lower than the intrinsic value. The second could be fundamental change, but price not followed. Now here, another example comes to my mind is HDFC Bank. If you look at the performance of HDFC Bank, they have been growing quarter after quarter. And banking is the key sector in our economy. If economy has to grow, bank has to do well, and that to private sector bank and well-managed bank. Now, if you look at the price of HDFC Bank, it has been stagnating since last 2 years. Primarily, one of the reasons is a huge sell by FIIs. But this company has got a huge value at this point in time, or the price of this particular share very often is lower than the intrinsic value. So it could be a good buy for the people who have patience. Competitors' valuation. Many times, you are in the sector and a new company comes with IPO, and what happens is that company IPO is priced high. So that gives opportunity to other company to re-rate its pricing. So that also could be opportunity. Another opportunity could be in terms of demerger of a company, when the company is split into two companies. So I am not saying all situations will be profitable, but need to really watch. Maybe you might get under these conditions a price which is lower than the intrinsic value, or sometime a share also trade at a price which is lower than the intrinsic value. Now, how to filter stock? In the stock exchange, there could be more than 5,000 shares which are listed on NSE. So how to filter? So some of the criteria which I have been using personally, they are listed here. Return on capital employed, return on equity. These two, like return on equity, must be greater than 15%. When you have less than 15%, maybe look for other stock. Don't commit to this stock. ROC and ROE is closer to each other if there is no leverage. But in case of leverage, ROC will be significantly different. So ROC certainly should be more than 15%. Higher the number, better it is. Sales growth and profit growth rate should be more than 10% consistently. The company should have a positive free cash flow. Now, these are the must criteria. You may create some more criteria for yourself. But if you do this, you will be good enough. It will be good enough. And then, having filtered a set of company, the next goal is how to find out the best price where you can look for a price which is lower than the intrinsic value. We have not discussed how to compute intrinsic value. In the detailed course which I am planning, intrinsic value discussion will come into play. So value filter could be P and PB. So I will show with help of an example how to use P and PB to filter a company once you have chosen some on this criteria. Let us take an example and discuss this case. Let's take Manali Petrochemicals. So Manali Petrochemical, this is a small size company, and if you look at market cap, it is just 1600 crores. See friends, the large company or the large cap companies, they are very stable companies, but the return will be limited. Whereas in small companies, you may have a huge return. If you had looked at the portfolio of Mr. Junjun Bala, he never owned any large company, and that is why he made a lot of return. So very important is your confidence. So idea of this video is to create confidence in your thinking. And once you do that, you will be good enough. So market cap is 1592 crores. Stock price earning is 4.68, which is quite lower. ROC is hopping 63% and ROE is 47.1%. So this passes on our first criteria of ROC and ROE. Now let's look at sales growth. 5 years growth is 20% and 3 years growth will be also sales growth 3 years is 27%. So that passes our sales growth criteria. Profit 5 years 55% and profit 3 years is also quite high, 90%. So it passes all the criteria of basic selection. Now the second thing comes cash flow. Free cash flow for 3 years is 585 crores and 5 years is 633 crores. So this is a good share we should look at. Now the question comes how to go and choose this based on our criteria of PB, PE we said. So these are some of the measures, but we'll discuss in detail in the course. But here I am taking median, like 5-year median is 7.3 and today it is trading at about 4.8 or 4.7. So this is quite lower than 5 years median. So certainly passes on that. If you look at 3 years, same way, almost 1/3 of the median. And if you look at 1 year, it is lower than the value, maybe by 10% or so. So all PE criteria, it is undervalued. Now let's take another criteria, price to book criteria. And this is coming from a screener, which I have been talking frequently. On a 5 years price to book, it is just at value, neither undervalued nor overvalued. 3 years, it is again slightly lower than the median, and 1 year, it is quite lower than the median. So friends, what I have seen is that both the criteria of P and PB, this share is doing quite well. So friends, what you have seen in this short video is what is value, what are the possible opportunity where you can look for value, and how to select shares and how to really narrow down and choose a company where the price is lower than the value. And if you can make at a price which is lower than the value, you will make a big gain at any particular point in time. So let's keep moving. Now I am giving you an example of some great people who really followed this particular pattern very nicely. Great value investors. So the first name, the legendary Warren Buffett, CEO of Berkshire Hathaway. Now this gentleman had made a very strong comment, which I think is worth quoting here. If you don't find a way to make money while you sleep, you will work until you die. Very powerful statement, isn't it? At least I get really motivated by seeing this statement. So you have to find a way where you keep on earning while you sleep. And then he says, for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Very important, friends. This means, sometimes we say that this is very good stock. If you buy it at a higher price, it will take many years to really gain a good value. And that is very, very significant. That's why value investing is very important. The second gentleman which comes into this range is Peter Lynch. He is the author of many books on investment. I have read quite a few of them. And you may like to read Beating the Street. It's a nice book. And I'll certainly recommend you to read this. This is going to be a very, very important book for you. I think it's a phenomena which should continue till we die. I have been doing that. At this stage is also, I learn, I share with you, my friends and colleagues. And therefore, I suggest that you should also do it. The next one is Benjamin Graham. By the way, this gentleman was guru of Warren Buffett. He was the one who talked about value investing and very early. He died in 1976. So he talked about that and he has been practicing that. There's a very important book by him, The Intelligent Investor. It's about 600-700 pages. You may like to look at this book as well. From India, there are many people, but Ramdeo Agarwal's name comes to my mind. This gentleman keeps on talking about good track records, buying at the right price. Second is Mr. Radha Krishna Damani. So these are some of the legendary who have done fantastic job in terms of value investing and propagating value investing. There's another young guy, Saurabh Mukherjee, which I have been following, of Marcellus Capital. He also was, I will not say fully value investing, but primarily the growth shares. But he says that any price you can pick up. But I personally believe that if you can do better on price as well, you will do much better. Coming to the end of this video, what we did is we discussed about value investing. We discussed about what is value and when you can look for value which is better than the intrinsic value, and you should try buying at intrinsic value. So it is very important that investment is a game where you need to have conviction. Whatever you are doing, you should be convinced that I have done right, and you should not look at it every moment. It is something like if you buy a piece of land, do you look at the price every day? Answer is no. Similarly, then why you are looking at the stock price every day? Warren Buffett says that it may be better if you choose a stock and stock exchange is closed for 5 years. So that could be the spirit of value investing. So and be confident, be patient, and then it is going to give you a rich reward. So friends, if you like this video, do subscribe to my channel and circulate this video to your friends and colleagues in the social groups, because that is what is going to help me building this channel. And thank you so much for your time and stay engaged.